Hello everyone, today we will discuss about kind of insurance in the world and their functions. Okay, let's start. Certain terms are usefully defined at the outset. Insurance is a contract of reimbursement. For example, it reimburses for losses from specified perils, such as fire, hurricane, and earthquake. An insurer is the company or person who promises to reimburse. The insured, sometimes called the assured, is the one who receives the payment, except in the case of life insurance, where payment goes to the beneficiary named in the life insurance contract. The premium is the consideration paid by the insured, usually annually or semi-annually, for the insurer's promise to reimburse. The contract itself is called the policy. The events insured against are known as risks or perils. Regulation of insurance is left mainly in the hands of state, rather than federal, authorities. Under the McCarran-Ferguson Act, Congress exempted state-regulated insurance companies from the federal antitrust laws. Every state now has an insurance department that oversees insurance rates, policy standards, reserves, and other aspects of the industry. Over the years, these departments have come under fire in many states for being ineffective and captives of the industry. Moreover, large insurers operate in all states, and both they and consumers must contend with 50 different state regulatory schemes that provide very different degrees of protection. From time to time, attempts have been made to bring insurance under federal regulation, but none have been successful. We begin with an overview of the types of insurance, from both a consumer and a business perspective. Then we examine in greater detail the three most important types of insurance: property, liability, and life. Public and private insurance. Sometimes a distinction is made between public and private insurance. Public, or social, insurance includes Social Security, Medicare, temporary disability insurance, and the like, funded through government plans. Private insurance plans, by contrast, are all types of coverage offered by private corporations or organizations. The focus of this chapter is private insurance. Types of insurance for the individual. Life insurance provides for your family or some other named beneficiaries on your death. Two general types are available. Term insurance provides coverage only during the term of the policy and pays off only on the insured's death. Whole life insurance provides savings as well as insurance and can let the insured collect before death. Health insurance. Health insurance covers the cost of hospitalization, visits to the doctor's office, and prescription medicines. The most useful policies, provided by many employers, are those that cover 100% of the costs of being hospitalized and 80% of the charges for medicine and a doctor's services. Usually, the policy will contain a deductible amount. The insurer will not make payments until after the deductible amount has been reached. 20 years ago, the deductible might have been the first $100 or $250 of charges. Today, it is often much higher. Disability insurance. A disability policy pays a certain percentage of an employee's wages, or a fixed sum, weekly or monthly, if the employee becomes unable to work through illness or an accident. Premiums are lower for policies with longer waiting periods before payments must be made. A policy that begins to pay a disabled worker within 30 days might cost twice as much as one that defers payment for 6 months. Homeowners insurance. A homeowner's policy provides insurance for damages or losses due to fire, theft, and other named perils. No policy routinely covers all perils. The homeowner must assess his needs by looking to the likely risks in his area: earthquake, hailstorm, flooding, and so on. Homeowners' policies provide for reduced coverage if the property is not insured for at least 80% of its replacement costs. In inflationary times, this requirement means that the owner must adjust the policy limits upward each year or purchase a rider that automatically adjusts for inflation. Where property values have dropped substantially, the owner of a home, or a commercial building, might find savings in lowering the policy's insured amount. Automobile policies are required in at least minimum amounts in all states. The typical automobile policy covers liability for bodily injury and property damage, medical payments, damage to or loss of the car itself, and attorney's fees in case of a lawsuit. Other liability insurance. In this litigious society, a person can be sued for just about anything. A slip on the walk, a harsh and untrue word spoken in anger, an accident on the ball field. A personal liability policy covers many types of these risks and can give coverage in excess of that provided by homeowners and automobile insurance. Such umbrella coverage is usually fairly inexpensive, perhaps $250 a year for $1 million in liability. Types of business insurance. Workers' compensation. Almost every business in every state must insure against injury to workers on the job. Some may do this through self-insurance, that is, by setting aside certain reserves for this contingency. Most smaller businesses purchase workers' compensation policies, available through commercial insurers, trade associations, or state funds. Automobile insurance. Any business that uses motor vehicles should maintain at least a minimum automobile insurance policy on the vehicles, covering personal injury, property damage, and general liability. Property insurance. No business should take a chance of leaving unprotected its buildings, permanent fixtures, machinery, inventory, and the like. Various property policies cover damage or loss to a company's own property or to property of others stored on the premises. Malpractice insurance. Professionals such as doctors, lawyers, and accountants will often purchase malpractice insurance to protect against claims made by disgruntled patients or clients. For doctors, the cost of such insurance has been rising over the past 30 years, largely because of larger jury awards against physicians who are negligent in the practice of their profession. Business interruption insurance. Depending on the size of the business and its vulnerability to losses resulting from damage to essential operating equipment or other property, a company may wish to purchase insurance that will cover loss of earnings if the business operations are interrupted in some way, by a strike, loss of power, loss of raw material supply, and so on. Liability insurance. Businesses face a host of risks that could result in property insurance. It is sometimes said that property is the foundation for a system of free market capitalism. If so, then protecting property is a necessary part of being part of that system, whether as an individual or as a business entity. Coverage. As we have noted, property insurance provides coverage for real and personal property owned by a business or an individual. Property insurance is also part of automobile policies covering damage to the car caused by an accident, collision coverage, or by other events such as vandalism or fire. Comprehensive coverage. Different levels of coverage are available. For example, many basic homeowners policies cover damage resulting from the following types of perils only: fire and lightning, windstorm and hail, explosions, riots and civil commotions, aircraft and vehicular accidents, smoke, vandalism and malicious mischief, theft, and breakage of glass that is part of a building. A broader policy, known as broad coverage, also includes these perils: falling objects, weight of ice, snow, and sleet, collapse of buildings, sudden and accidental damage to heating systems, accidental discharge from plumbing, heating, or air conditioning systems, freezing of heating, plumbing, and air conditioning systems, and sudden and accidental injury from excess currents to electrical appliances and wiring. Even with the broadest form of coverage, known as comprehensive, which covers all perils except for certain named exclusions, the homeowner can be left without protection. For example, comprehensive policies do not usually cover damage resulting from flooding, earthquakes, war, or nuclear radiation. The homeowner can purchase separate coverage for these perils, but usually at a steep premium. Insurable interest in property. To purchase property insurance, the would-be insured must have an insurable interest in the property. Insurable interest is a real and substantial interest in specific property such that a loss to the insured would ensue if the property were damaged. You could not, for instance, take out an insurance policy on a motel down the block with which you have no connection. If a fire destroyed it, you would suffer no economic loss. But if you helped finance the motel and had an investment interest in it, you would be permitted to place an insurance policy on it. This requirement of an insurable interest stems from the public policy against wagering. If you could insure anything, you would in effect be betting. Assignment is the transfer of any property right to another. In property insurance, a distinction is made between assignment of the coverage and assignment of the proceeds. Ordinarily, the insured may not assign the policy itself without the insurer's permission. That is, he may not commit the insurer to insure someone else. But the insured may assign any claims against the insurer, for example, the proceeds not yet paid out on a claim for a house that has already burned down. Intentional losses insurance is a means of spreading risk. It is economically feasible because not every house burns down and not every car is stolen. The number that do burn down or that are stolen can be calculated and the premium set accordingly. Events that will certainly happen, like ordinary wear and tear and the destruction of property through deliberate acts such as arson, must be excluded from such calculations. The injury must result from accidental, not deliberate, causes. Coinsurance clause. Most commercial property policies contain a so-called coinsurance clause, which requires the insured to maintain insurance equal to a specified percentage of the property value. It is often 80% but may be higher or lower. If the property owner insures for less than that percentage, the recovery will be reduced. In effect, the owner becomes a coinsurer with the insurance company. The usual formula establishes the proportion that the insurer must pay by calculating the ratio of 1. The amount of insurance actually taken to 2. The coinsurance percentage multiplied by the total dollar value of the property. Suppose a fire causes $160,000 damage to a plant worth $1 million. The plant should have been insured for 80%, $800,000, but the insured took out only a $500,000 policy. He will recover only $100,000. To see why, multiply the total damages of $160,000 by the coinsurance proportion of 5/8, $500,000 of insurance on the required minimum of $800,000. 5/8 of $160,000 equals $100,000, which would be the insured's recovery where the policy has a coinsurance clause. Liability insurance. Liability insurance has taken on great importance for both individuals and businesses in contemporary society. Liability insurance covers specific types of legal liabilities that a homeowner, driver, professional, business executive, or business itself might incur in the round of daily activities. A business is always at risk in sending products into the NoFault trends. The major legal development of the century relating to liability insurance has been the elimination of liability in the two areas of greatest exposure, in the workplace and on the highway. In the next unit on agency law, we discuss the no-fault system of workers' compensation, under which a worker receives automatic benefits for workplace injuries and gives up the right to sue the employer under common law theories of liability. Here we will look briefly at the other major type of no-fault system: recovery for damages stemming from motor vehicle accidents. No fault means that recovery for damages in an accident no longer depends on who was at fault in causing it. A motorist will file a claim to recover his actual damages, medical expenses, income loss, directly from his own insurer. The no-fault system dispenses with the costly and uncertain tort system of having to prove negligence in court. Many states have adopted one form or another of no-fault automobile insurance, but even in these states the car owner must still carry other insurance. Some no-fault systems have a dollar threshold, above which a victim may sue for medical expenses or other losses. Other states use a verbal threshold, which permits suits for serious injury, defined variously as disfigurement, fracture, or permanent disability. These thresholds have prevented no-fault from working as efficiently as theory predicts. Inflation has reduced the power of dollar thresholds, in some states as low as $200, to deter lawsuits, and the verbal thresholds have standards that can only be defined in court, so much litigation continues. No state has adopted a pure, no-fault system. A pure no-fault system trades away entirely the right to sue in return for the prompt payment of first-party insurance benefits. That is, payment by the victim's own insurance company instead of traditional third-party coverage, in which the victim collects from the defendant's insurance company. Among the criticisms of no-fault insurance is the argument that it fails to strengthen the central purpose of the tort system: to deter unsafe conduct that causes accidents. No-fault lessens, it is said, the incentive to avoid accidents. In any event, no-fault automobile insurance has been a major development in the insurance field since 1970 and seems destined to be a permanent fixture of insurance law. Life insurance. Insurable interest. The two types of life insurance mentioned in Section 19. Subrogation. Unlike property insurance, life insurance does not permit subrogation. The insurer must pay the claim when the insured dies and may not step into the shoes of anyone entitled to file a wrongful death claim against a person who caused the death. Of course, if the insured died of natural causes, there would be no one to sue anyway. Change of beneficiary and assignment. Unless the insured reserves the right to change beneficiaries, his or her initial designation is irrevocable. These days, however, most policies do reserve the right if certain formalities are observed, including written instructions to the insurer's home office to make the change and endorsement of the policy. The insured may assign the policy, but the beneficiary has priority to collect over the assignee if the right to change beneficiaries has not been reserved. If the policy permits beneficiaries to be changed, then the assignee will have priority over the original beneficiary. Intentional losses. Two types of intentional losses are especially important in life insurance: suicide and murder of the insured by the beneficiary. Suicide. In a majority of states, in the absence of a suicide clause in the policy, when an insured commits suicide, the insurer need not pay out if the policy is payable to the insured's estate. However, if the policy is payable to a third person, e.g., the insured's company, payment will usually be allowed. And if an insured kills himself while insane, all states require payment, whether to the estate or a third party. Most life insurance policies today have a provision that explicitly accepts suicide from coverage for a limited period, such as 2 years, after the policy is issued. In other words, if the insured commits suicide within the first 2 years, the insurer will refund the premiums to his estate but will not pay the policy amount. After 2 years, suicide is treated as any other death would be. Murder. Under the law in every state, a beneficiary who kills the insured in order to collect the life insurance is barred from receiving it. But the invocation of that rule does not absolve the insurer of liability to pay the policy amount. An alternate beneficiary must be found. Sometimes the policy will name contingent beneficiaries, and many, but not all, states require the insurer to pay the contingent beneficiaries. When there are no contingent beneficiaries or the state law prohibits paying them, the insurer will pay the insured's est.